Well, our long-term model, proprietary model, flipped positive in October of 2008. In fact, the majority of stocks bottomed in October of '08, not March of '09. The indices kept going down because the financials went down into March of '09. But the majority of stocks, in fact, 92.6% of all stocks traded on the New York Stock Exchange bottomed on October 10th of 2008, which is when our long-term proprietary model flipped positive. Now, our intermediate proprietary model and our shorter-term proprietary models flipped positive the week before the election, suggesting that no matter who gets elected, there's going to be a rally in the equity markets. Now, obviously, the Trump win gave the market bigger legs because regulatory reform, lower corporate tax rates, a plethora of things. Those models were calling for a window of downside vulnerability in late January or early February. So far, that's not been a good call. And in this business, when you're wrong, you say you're wrong, and you be wrong quickly for a de minimis loss of capital. What I have learned is that it's very difficult to forecast on a short-term basis when President Trump is tweeting different things all the time, and they are affecting the markets. Just last week, when he said he's going to have a phenomenal tax plan that's going to come out in the next couple of weeks, the markets went from down on the week to up on the week. So from just a right brain standpoint, it makes sense to me that you would get some kind of short-term market peak on that tax plan announcement and some attempt to pull stocks back. However, any pullback, we think, is for buying because we think the secular bull market has years left to run.